Good evening. Welcome back. All right, before we get going, quick disclaimer. Everything I share in this video is for educational purposes only. Nothing here is financial or investment advice. I'm not a financial advisor, and the ETFs I mentioned are just examples for my own portfolio, not recommendations for you specifically. Always do your own research and consult a qualified professional before making any investment decisions. All right, also real quick, the update to my 3-engine portfolio will be coming soon, shortly after this video. I'm just putting the finishing touches on it right now. Okay, so from my experience, the biggest mistake that I think people make when they first open a brokerage app is they treat it like a casino. They log in, they see a bunch of green and red or orange blinking numbers, and they buy whatever stock's trending that day or whatever's good in the news. And that's the fast track to losing your hard-earned money. I've actually done it that way. I'm guilty of that. I'd see the stocks going up, they'd shoot up, and I'd buy them when they were at the highest point. Then I'd get scared, and when they'd start dropping down, and I'd get real scared, think I was going to lose all my money, and I'd sell it, and it would shoot back up. But here's the thing. Investing isn't a gamble if you have a blueprint. And today, I'm going to give you that blueprint. And you can run this on any brokerage you want. Robinhood, Fidelity, Schwab, Webull. It doesn't really matter. The system works everywhere. So I treat my portfolio like a machine with 3 distinct engines. Each one has a specific job. The safety protects you. Growth helps build your wealth over time. And income will help pay you while you just hold it. So together they work as a system. And that's what separates people who actually build wealth from people who just gamble and hope. And before we break into each engine and break them down, I want to quickly explain one term you're going to hear me say a lot: ETF. An ETF is an exchange traded fund. It's basically a ready-made basket of investments you can buy like a single stock. So instead of picking one company and hoping that one wins, you buy an ETF and instantly own a slice or dozens or hundreds of assets all at once. Usually low cost, simple, and incredibly powerful for beginners. And that's it. It's pretty simple. Just because when I say simple, I guess it's not really that simple, but meaning that if you just buy the S&P 500, you're going to own part of all 500 of those companies. There's a lot of ETFs that will overlap and have some of the same companies in it, but just do your research and you can find out what best fits you. So here are the 3 engines. So the safety engine, that's going to be your foundation. So I want to be clear. This isn't just going to be cash sitting in your savings account doing nothing. This is your money working quietly in the background through carefully chosen ETFs that prioritize stability over and income over big swings. So in my own safety engine, right now I hold 3 ETFs: USHY, SCHD, and IBHF. So let me break down each one for you. USHY is a high-yield corporate bond ETF. You're essentially lending money to a broad basket of companies and collecting their interest payments. More stable than choosing individual stocks, and it pays you regularly. I also hold SCHD, and you might have heard of this one. This is one of the most popular dividend ETFs out there. It holds high-quality U.S. companies with a long track record of paying and growing their dividends. Stability and growing income in just one ticker. And then I use IBHF, and this is a defined maturity bond ETF. Think of it like a bond with an end date, almost like a CD at a bank. You know roughly what you'll get back and when. Predictable, stable, and perfect for this layer. And so you don't have to own these exact 3. The point is to find ETFs that lean toward income, stability, and lower volatility. These just happen to fit my strategy right now, and I could change them at any time. Do your own research and pick what fits yours. This engine is your protective wall. If the market tanks tomorrow, it keeps you from being forced to sell your growth investments just to cover an emergency. All right, so once your foundation is solid, it's time to build wealth. And that's the growth engine. So for beginners, you don't need to stress over picking individual stocks or guessing which tech company is going to double next week. You want broad market ETFs, specifically ones that track the S&P 500, which is basically a scoreboard of the 500 largest companies in the US. You buy one ticker and you're instantly invested in Apple, Microsoft, Amazon, and hundreds more all at once. And over the last century, the US market has consistently grown long term. So this is your compound interest engine, and time is going to be fuel. Okay. And finally, the income engine. And honestly, this is where investing starts to feel really fun. This engine holds assets that pay you just for owning them. That's dividends. The other engines also have some dividends as well. So when profitable companies distribute a portion of earnings back to shareholders, you collect that cash. And on any major brokerage, Robinhood, Fidelity, Schwab, you can set those dividends to automatically reinvest back into those same assets. Every payment will buy you a tiny fraction more, and those fractions will add up. Over time, it becomes a snowball that feeds itself, cash flow generating more cash flow without you doing anything. All right. Here is exactly how you put this together on any brokerage. So step one, you're going to want to fund your account and build your safety layer. Link your bank, transfer whatever you're comfortable with, and put your safety allocation into stable income ETFs. Think USHY, SCHD, IBHF, or whatever fits your situation. Steady yield's a goal, not big gains. And then step two, use fractional shares. Don't wait until you have thousands of dollars saved up. I try to save up just so I could buy one share of something. It's easier if you just, and most brokerages will let you buy fractional shares now. You can put in $10 or $20, and that gets you into any ETF at the exact same percentage growth as someone holding the full share. And then step three, you want to make sure you turn on dividend reinvestment. Go into your brokerage settings, find dividend reinvestment, usually under investing or account settings, and then just flip that on. And then your income engine now snowballs automatically. And then step four, you want to automate and stay consistent. Set up a recurring deposit, even if it's just $5 a week or $50 a month, whatever you're comfortable with, just do consistently. And split it across your three engines or just one engine if you choose. The real edge in investing isn't picking the right stock. It's just showing up consistently and letting time do the work. Okay, that's the blueprint. Safety, growth, income. 3 engines, 1 system, any brokerage. You don't need a massive bankroll. You don't need to be an expert. You just need a clear structure and the discipline to stick with it. So drop a comment below and tell me which engine are you starting with. Like this video if it helped. Subscribe so you don't miss the next update. And we'll see you on the next one.